Once hailed as a visionary disruptor, WeWork captivated investors with its promise to revolutionize how we work and live. At its peak in early 2019, the co-working giant commanded a staggering private valuation of $47 billion, positioning itself as a tech titan rather than a conventional real estate play. Its charismatic founder, Adam Neumann, painted a future where flexible office spaces fostered community and innovation. Yet, within months, the seemingly unstoppable juggernaut spiraled into a catastrophic collapse, leaving a trail of shattered dreams, billions in lost capital, and a stark lesson in market exuberance and corporate governance. How did a company with such immense potential tumble so spectacularly? At the core of WeWork's meteoric rise was Adam Neumann, a co-founder with an almost messianic zeal. He wasn't just selling office space, he was selling a lifestyle, a global community, a mission to elevate the world's consciousness. Investors, particularly SoftBank's Masayoshi Son, were utterly charmed by Neumann's grand pronouncements and boundless ambition. He cultivated an intoxicating culture that blurred the lines between work and play, fueled by extravagant parties and a utopian vision that resonated deeply with the zeitgeist of modern startup culture. His ability to articulate this aspirational narrative was a key driver of early investment. WeWork's growth trajectory was nothing short of astonishing. From a single office in 2010, it expanded to hundreds of locations across dozens of countries, attracting massive funding rounds at ever-increasing valuations. Venture capital flowed freely, culminating in a colossal $10 billion investment from SoftBank, elevating WeWork's total funding to over $12.8 billion. This capital fueled aggressive global expansion, allowing WeWork to undercut competitors and secure prime real estate, often at a loss, in pursuit of market dominance. The mantra was growth at all costs, a familiar Silicon Valley narrative that often overlooked underlying financial fundamentals. Despite its tech company branding, WeWork was fundamentally a commercial real estate company with a critical flaw: it took on long-term lease commitments, typically 10 to 15 years, for its properties, while offering its customers highly flexible, short-term memberships. This created an immense mismatch, exposing WeWork to significant risk during economic downturns or periods of low occupancy. As a landlord, it faced high fixed costs, but as a flexible space provider, its revenue stream was inherently volatile. The narrative of an asset-light technology platform was misleading, concealing a deeply capital-intensive operation with massive operational leverage. As WeWork scaled, glaring corporate governance issues emerged, largely centered around Adam Neumann's control and self-dealing. He trademarked the We name and then sold the rights back to the company for nearly $6 million, an egregious conflict of interest. Neumann also borrowed heavily from the company, owned properties leased by WeWork, and exhibited erratic behavior, including firing employees on whims. These actions, combined with lavish spending and a lack of clear financial oversight, signaled a profound disregard for fiduciary duty and investor interests, eroding trust long before the public market had its say. The turning point arrived with WeWork's S-1 filing for its IPO in August 2019. This document, intended to showcase its strengths, instead laid bare the company's precarious financials, governance failures, and enormous losses. Investors were shocked by the sheer scale of the losses, the dubious related party transactions, and Neumann's dictatorial control via supervoting shares. Public market scrutiny swiftly peeled back the tech company facade, revealing a highly unprofitable real estate venture masquerading as innovation. The initial $47 billion valuation became a laughingstock, with analysts suggesting figures as low as $10 to $15 billion. The public backlash was immediate and severe. The IPO was pulled, and WeWork's valuation plummeted from its peak of $47 billion to an abysmal $8 billion in a matter of weeks. The company, on the brink of bankruptcy, was forced into a desperate rescue by its largest investor, SoftBank. This involved SoftBank taking an 80% stake, pumping in additional billions, and installing a new leadership team. The dream of a triumphant public debut dissolved into a stark reality check for investors and a painful lesson in due diligence, exposing the true cost of unchecked ambition and a lack of financial discipline. In a final twist of irony and outrage, Adam Neumann was effectively ousted as CEO but received a staggering exit package worth over $1.7 billion. This included selling his shares, a $185 million consulting fee, and a $500 million credit line, all while thousands of WeWork employees faced layoffs and investors absorbed monumental losses. The optics were terrible. The architect of the disaster walked away incredibly wealthy, shielded by SoftBank's desperate need to salvage its investment, while the company itself struggled for survival. This disparity underscored the profound disconnect between founder rewards and shareholder value. The WeWork saga stands as a powerful cautionary tale for the startup ecosystem and venture capital world. It exposed the dangers of unchecked founder power, weak corporate governance, and the pitfalls of valuing companies based purely on narrative and growth potential, rather unforeseen fundamental financial realities. It reminded investors that even the most charismatic leaders cannot defy economic gravity indefinitely. Ultimately, WeWork's downfall served as a brutal re-evaluation of valuation multiples, fostering a more skeptical environment for highly ambitious, yet unprofitable, private companies seeking public market debuts.